Hello and welcome. You're watching KYC. I'm Hersh Sayta. Today we're going to focus in on KRBL. It's the rice maker in focus, and that's because FY26 could well be the year in which you see a big turnaround in KRBL's numbers. I want to know whether that is actually possible or not, because you've seen a drag over the last 3 years, and we'll go through some of the numbers. We'll also go through how the business has done, what the risks are, and that will give you a better picture. But you want to know whether export demand and growth will come back in a big fashion in FY26. And if it does, you might well see a very large turnaround with regard to the numbers, both on the top line as well as on margins, because this is where it's been a drag where the business is concerned. So that's the first point. The second point is with regard to outlook in global markets. Saudi has its set of issues with regard to distributors. US has its set of issues, and Europe has its set of issues. Europe is seeing, or rather the European business is seeing competition from Pakistan. So a lot of those factors, can it unwind in FY26, aid the numbers for FY26, and how long can those trends last going forward? All of that is what I want to understand. The second one is scope for margin expansion. So one is, can pricing come back in a big fashion? Can some of these markets see a recovery? And then will that drive up margins? Because the other piece that's dragging back margin is the pricing and the high cost inventory, which is just coming up on your screen. So that's what's really keeping the margins, or keeping a lid with regard to margins. Is that drag truly over? Then it'll be a double unwind. It'll be an unwind on the top line as well as unwind on the margins, which will be large. So I want to also understand, therefore, how the margin outlook is. Will both of those shape up in FY26, or will you see some bit of that in FY26, some bit of that in FY27? So, Then I want to also understand how the domestic market is going to be doing. You could well again see some bit of tailwind even from the domestic market. Last piece is they are also venturing into new products. Edible oil is one of them. Then you have several other new initiatives which they will likely take up. Their new manufacturing facility is also coming on stream. And therefore, you've got all of those tailwinds also, which could likely aid the numbers in FY26. So it's an interesting inflection point at which we are currently placed where KRBL is concerned. But first off, as we always do, let's look at how the business is and what does it do. I'm going to, again, try my best to break this down. It's the leading basmati rice producer in the country. It's fully integrated in terms of its operations. It's a pioneer in the basmati rice industry. All of these is what it does, fully integrated, from seed development, contact farming, procurement of paddy, storage. Again, paddy prices is the other piece which could well impact numbers. Processing, packaging, branding and marketing. So it does all of that. It has its own brand, which is one of the largest brands in the country. It owns India Gate basmati rice. This one has a market share of 39% in general trade and a higher market share of 42% in modern trade in India. And therefore, it's a large market share that KRBL actually has. It's the largest packaged exporter as well of basmati rice from India, exports across 90+ countries. We'll come to the export numbers in just a bit. Let's talk a bit about the domestic numbers first. The distribution network. It has more than 850 dealers across India, and it covers over 4.1 lakh or nearly 4.1 lakh retail outlets as of FY25. And now let's talk about exports. 90+ countries is what it exports to. And I will again give you geography-wise, but before that, manufacturing. It manufactures across all of these geographies, as you can see. So it has a decent presence, especially north as well as West India, a decent bit of presence across those areas, which helps them also have a decent grip over distribution. Last off, let's talk about exports now. 90+ countries is what it exports to. 29% better realization. When you're looking at region-wise export, and I told you I'll give you this. One is Middle East is roughly 58%, Africa is 11%, Europe is 11%. So that takes your number to around 80-odd%. Thereafter, you have North America with 10%, and then you have others with 10%. So that's how it is. The max as you can see in terms of the number, is that Middle East number. And this is where they face some bit of concern with recently, especially with regard to distributors. How quickly can that get resolved? And part of it is already resolved, but how quickly can that unwind and start making a dent on numbers overall and gain all the market share that they've lost? That's a key piece of what I want to understand. In terms of domestic business, as you can see on your screen, it's accounted for around 74% of the total revenue in FY25. Does that change materially in FY26? And it's also got the largest rice milling plant in the country. In terms of new segment, let's talk about that and put that out of the way as well. It entered into the healthy edible oil segment and expects to generate around 200 to 250 crore in revenue over the next 2 to 3 years. That's the outlook with regard to new business as well. So that could well impact the numbers as well. Now let's talk about the factors that we'll have to watch out for when we're talking about KRBL. And I'll start off, of course, with the income statement, the balance sheet, the cash flow, the return ratios, the shareholding, the street cred, the outlook, and the valuations. A lot of this, of course, is backward looking. That's an important caveat to look at. And therefore, the ratings will obviously be on the basis of the numbers that have played out over the last 3 years or so. Again, important caveat, because all your returns going forward will be basis how the future plays out of the company. So one is you want to look at how the company has done over the last 3 years, but you also want to understand whether there is a reasonable turnaround possibility going forward, because that's what makes an investment interesting. So let's pull up the income statement. Let's start off with that. You look at the 3-year CAGR on the top line, it's just 10%. It's clocked a top line of around 5,600 crore. It's been a largely flattish kind of a move on the top line. EBITDA has been even more difficult to see growth there. Just a 4% 3-year CAGR growth. EBITDA has actually tapered off in FY25, so you're seeing more pressure. Cost side pressures is what's weighing it down. You have paddy prices which had inched up. You have realization prices, or rather realizations which haven't materialized as well as one would expect it to. And then you have all the drags from the businesses, especially sitting out of Europe, where there have been certain challenges. And therefore, you're seeing the kind of numbers that you're seeing. Profit after tax up 1% on the last 3-year CAGR basis. So not looking impressive, and no reason why one should even give this a neutral. It's a difficult time, and therefore we've given this at best a thumbs down. In fact, when I'm looking at the journey, right, from FY22, profits in FY22 were at 459 crore, 701 crore in FY23, fell to 596 crore in FY24, fell to 476 crore in FY25. So you want to see whether this again quickly unwinds and whether profitability kick-starts or not in terms of strong growth in FY26. And that's where you want to then compare the valuation which is available currently versus previously, or rather 5-year average, and see whether this could well be lucrative or not. And of course, everyone has to do that individually. Let's look at the balance sheet now. In terms of equity capital, it's fairly well capitalized. It's got very little to no borrowing, frankly, on the balance sheet, at least at this point. It has a short-term borrowing of around 300 odd crore, but it's a very small quantum in terms of borrowing, given that it has an 8,000 crore market cap, and it has 5,000 crore sitting in equities. So very little to no borrowing per se, and in fact it's net cash positive at this point, because the cash that's sitting on the balance sheet is quite large. You have approximately 450 crore of cash sitting on the balance sheet, as you can see on your screen. So no concern with regard to the balance sheet. Will give this a strong thumbs up. And mind you, it is a cash flow generating company. The only concern possibly with the balance sheet is that inventories are quite elevated and inventory costs start to pile up, and you want to see whether that can be controlled or not. Optimizing inventory is important for a business like KRBL. Can they manage to do that? Well, they've suggested in their Q3 FY25 earnings call that they continue to work on the inventory angle of things. Can that change, or has that materially changed? Are we starting to see results? Is something, of course, that we'll quiz management on. But otherwise, there's no concern. Where the balance sheet is concerned, the numbers look solid. Let's talk about cash flows. And my point on inventory spills over to cash flow. You look at the cash flow from operations in FY24, it's largely looking tough because of the rising inventory on the balance sheet. I'll spell out the numbers for you. Inventory rose by 1,370 crore in FY23. It rose by another 264 crore in FY24. So what that does is, it puts a lid on the free cash flow coming through into the business. Your cash flow from operations gets capped because all of the money that you are currently having is locked in inventory. You want that to materialize into sales and that pressure from inventory get released, but that's not happened. Whereas in FY25, that has started to unwind. So the inventory unwind in FY25 versus FY23 and 24 is of 566 crores. So you can see a large inventory unwind that's coming in FY25. And therefore, when you're seeing that operating cash flow to PAT ratio, which is on your screen, so cash flow from operations, PAT, and then OCF to PAT, which is operating cash flow to PAT, that's 131% in FY25, and that's because of the inventory unwind that's happened. So as that unwind happens, you will start to see cash flow coming through, which is what you want to see in a business like KRBL, or in any business for that matter. Cash flow from operations is the key. So that's with regard to the cash flow. We'll give this a neutral. Does that sustain? Does it go back? Do we again see an inventory build up? How certain are we of that? We will quiz management and we'll try and see what they have to say on that count. Now let's talk about return ratios. And obviously, as you've seen, it's been a difficult time for the business, and therefore you see the return ratios not looking pretty at all. So yes, FY23 was a decent year, 15% ROC, but thereafter we are seeing a tapering down. You want to wait and watch and see how this plays out as ROC starts to normalize, if profitability starts to pick up. So we've given this a neutral for now because you've seen a sharp unwind with regard to ROC and ROE ratios. Let's talk about shareholding now. No concern where shareholding is concerned, because you're seeing a 60% stable holding by the promoter group. I want to also try and probably just quickly highlight that they've held anything between 58.8% to 60.2% between FY17 to FY25, and currently their holding is at its peak. I know it's just a 1.5 to 2% variance, but its holding is, the promoter holding is at its peak, at least in the last 8-year period that we are considering at this point. So strong thumbs up. It's a strong promoter holding. FI interest has sharply fell in FY22. Thereafter, we've started to see a little bit of a trickle back. And since FY20, the FI holding is at its all-time high at 5%. DIIs in any case were very small, so I won't cover that. We have government holding in this as well. I'm going to spell that out. And the government currently owns around 6.3% of this company. Public, therefore, is sitting with around 28%. The peak public holding was at 34%. It had tapered down and has consistently tapered down, and currently sits at a 7-year low of 28%. The number of shareholders, though, has gone up quite significantly. From 35,000 odd in FY20, it's currently sitting at 115,000. So again, just for your understanding, what is the investor composition in something like a KRBL? So that's on investor composition. Now let me talk to you a little bit about street cred and how the stock has moved over the last year or so. It's given decent returns for a small cap company, 11% 1 month, 16% 6 months, 18% year to date, and around 18% over the last 12 months as well. So fairly steady in this large correction that we've seen since September of 2024. We've not seen too much damage on the stock price, and therefore that's a positive. But the 5-year returns is 45%. So you want to wait and watch how this plays out in terms of stock price performance, because we've not seen that. We've given this a neutral. Now I want to talk to you a little bit about what to look out for. What's the outlook like? What are the risks like? And this becomes important prior to the conversation. One, demand from Middle East, Europe, US is likely to support growth going forward, is what management has said. Q1 FY26 gross EBITDA at around 15% odd is what they've guided for. FY25 paddy prices are down 20% YOY. That's what they've said. Healthy edible oil launch also will aid the numbers going forward. How much? We'll have to quiz management on. Risks. Pricing pressure from exports is one risk, which is realizations, as you call it. Second, can paddy prices rise? Can that be a risk? For sure. Plus high cost inventory, could that weigh numbers? Is the other big risk. Distributor issues in Saudi as well as moreover Middle East. Is that, or does that continue to be a concern? And competition from Pakistan in that European market could also be the other piece. So we've given this a neutral in terms of outlook and risks. There are plenty of them playing out. I want to quickly talk about valuations. Now, when you're looking at the trailing 12 months price to earnings, KRBL trades at 17 times. And we've taken trailing 12 months because there's only one analyst which tracks KRBL, and therefore we don't want to skew the data, right? So KRBL 17 times, but you look at LT Foods at 26 times, Chamanlal at around 17 times as well, and therefore we've given the valuations a neutral. Also, the 5-year average valuations are far lower compared to the current valuation. So again, you want to see whether there's substantial growth in profit and a valuation number 1 year forward looks attractive or not. So maybe something that we'll get better perspective on once we speak with the CFO, Ashish Jain, who's going to join us in just a minute after we take the ratings. Let's pull up the ratings now and sum up everything we've spoken about. One, the income statement, thumbs down, want more on growth. Balance sheet, cash flow, return ratios, that's how it's spelt out. And then we have shareholding, street cred, outlook, and risks and valuation. That gives us a 4.5 out of 8 on our KYC ratings. But let me go across. Mr. Ashish Jain joining us, CFO KRBL, to talk to us about the outlook in FY26. Good morning, Ashish. I want to first start off by asking you how the outlook from an export perspective looks like for FY26. Is there enough tailwind? Are the issues in each of those markets looking much better than they were in FY24 or 25?
Yeah, good morning and thank you for having us. From export point of view, we have two sides of the business. One is where we export a branded rice, and the other is the bulk export. On the branded rice exports, you would have seen in the last quarter as well as last year, the performance is far better than the preceding year. We are hoping that this year is far stronger in terms of branded exports. One of the reasons is that we are seeing good offtake in Saudi, which is one of our largest markets. So that's on the branded export side. On the bulk export side, it tends to be affected by geopolitical risks. So some of the recent news items, including the Israel-Iran conflict, is something that we are watching closely. So overall, neutral to positive output for exports for FY26.
Okay, and Ashish, just talk to us about geography specific. How is Europe shaping up? How is the Middle East shaping up for you? You've allotted a distributor. The export numbers for Q4 look better. Is this the kind of number that you will start to clock? And what's the revenue mix going to be like in terms of exports? Because currently revenue is skewed towards domestic likely because of certain challenges.
Sure. So, if we look at basmati export from India, the Middle East accounts for around 80 to 85% of the total export of basmati from India. So for KRBL as well, Middle East is an important market, so therefore in terms of the geography mix, it is really the overall direction of exports of basmati from India, and KRBL is no exception. Now, from our point of view, all Middle East countries are markets, but some markets are more important than the other. So one of our key markets is Saudi, where, we have not yet appointed a distributor. However, we've seen local importers, because of the demand for India Gate rice, placing orders on us, and which we've been shipping. So that continues to happen. But of course, the overall market in terms of full potential will be realized once we have a more systematic distribution arrangement in place, which we are in the process of doing right now. Now, in terms of export versus domestic share, so if you look at our record in the past, traditionally these two segments have been roughly 50-50 in terms of revenue share. Over the last few years, because of various aspects, including the distribution challenge that we had in Saudi Arabia and some other industry-wide challenges, export has been rather muted, and because while the domestic business has grown, so which is why the share of domestic business has increased. However, we continue to be very positive on export in the long run. The reason for that are very simple. 85% of basmati production is in India. So regardless of where basmati is consumed, the world looks at India for supplying that, and KRBL is very well placed in meeting that demand. So longer term demand is not a challenge. The country enjoys a natural advantage. KRBL is a natural leader as far as branded exports is concerned. So the long term potential is intact. And therefore, we are very hopeful in terms of restoring the share of both segments in our revenue.
Okay, and how quickly does Saudi normalize, sir? Give us that perspective.
Yeah, so our view right now is that we want to use the current financial year to address the distribution challenges that we had. As I mentioned earlier, the offtake in terms of supply to local wholesalers has already begun. The other efforts we are in the process of doing. So our hope right now is that in the current financial year, we are able to fix these issues.
Okay, what does the interplay between inventory, between paddy prices, and between your top line growth do to margins, sir? Give us a perspective on what we should expect on the margin count in FY26.
Yeah, sure. So before that, let me just give you a perspective on our inventory. And I did hear your comments earlier in the program. KRBL focuses on aging rice. So rice as a grain improves with age. And what we offer to the consumers across most of our SKUs is aged rice. That plus the fact that rice is a seasonal produce in India. So 95% of rice production in India, at least as far as basmati concerned, is harvested in Kharif, which is the months of October to December. So most branded and large rice players stock up their inventory. So which is why you see higher inventory, and then as we approach as the year goes, the inventory levels fall. So because of the business model which focuses on aging, and because of the seasonal nature of the raw material, which is paddy, we carry relatively large inventories. However, that per se is not a challenge. So if you look at our track record, we've had a very long track record of successfully managing inventory. So therefore, we have internal processes to mitigate risks that might typically arise from large inventories. Now, in terms of interplay on margins, so when we age rice, it is fundamentally a different product from a rice which has just been harvested, because like I said, the grain improves with time. So let's say if we purchase paddy in end of calendar year 2024, when it has been aged for a few months or maybe even a year, it is a different and a superior product. So that combined with a brand, it gives us the ability to sell that in the market at higher prices. Now, because of this buffer that we have in terms of higher realization, the price fluctuations in the commodity rice market, we are able to offset. And again, like I said, we have a long history of being able to do so. So largely the variations in the domestic rice prices do affect us, but not in the entire magnitude as they would affect a traditional trading company or a commodity player. So that's the interlink between inventory and margins.
So, sir, very simply put, is there scope for margin upside, and how close to 15% do you get to in FY26? What's the goal?
Yeah, so I've mentioned earlier, so, if you look at our Q4 margins, margin profile improved. And I've said that broadly, that's the level that we are hoping to achieve in FY26, primarily for two reasons. One is we are hoping to see better export numbers. Exports, typically branded exports tend to be higher margin as compared to the domestic market. So as share of branded export increases, which we are hoping to do, the margin should see an uplift. And similarly, our inventory cost should also rationalize itself as the share of the recent crop which we purchased increases in the overall inventory. So because of those two reasons, we hope to see higher margins in FY26.
So a 16% margin is the threshold you're looking at because that's what you've done in Q4.
Yeah, so see, we don't give numerical guidance, but
Sure.
Q4 is a good indicator.
Sure, fair. Okay, yeah. Completely take your point. And so on the top line growth, now with exports coming back, does that grow as well? How should one look at that number?
See, with exports, like I said, we are evolving the situation in Saudi in terms of the distribution side. In terms of the bulk side, it continues to be wait and watch, given the recent events that have happened. So we are positive on exports, but difficult for me to give out a number at this point.
And paddy prices falling, are we seeing that sustain FY26?
See, paddy prices, like I said, 90 to 95% of the basmati paddy is harvested in the Kharif season.
Yes.
And that's when the price discovery really happens. So there is a price that gets discovered during the season. And then after that, of course, paddy and rice are traded. So the price keeps changing every day. So at this point, even before the monsoon has set in, it's very difficult to comment on how the upcoming season should behave. It's too early right now.
Okay. So we'll wait and watch on that. What about new businesses? Let's talk about the edible oils business. How quickly does that contribute to top line? Does it go 200 to 50 crores straight away from FY26? And what's the margin outlook there? What's the kind of margins you are expecting to clock?
Yeah, I'll just quickly give you a perspective on how we see new businesses. So, we believe that KRBL brings a couple of strengths. So one is, of course, our brand, IndiaGate. The second is, the platform that we bring in terms of our ability to source directly from mandis and farmers and, place it right on a retailer's shelf. And third is, of course, our ability to invest in upcoming businesses. So with that, we are looking at various new ideas. One of them, which we launched recently, is healthy edible oil. So I think that has a very strong fit. The reason is the primary raw material for that is rice bran oil, which is something that we already produce as a part of our rice milling and processing capabilities. In terms of how quickly it scales up, well, we've just launched it. The initial reaction is strong. We are first taking it across the broader channels like GT. And we are looking at about 2 to 3 crore number in maybe 2 to 3 years out of that product.
Okay. Thank you so much, Ashish, for joining us. In fact, great perspective, of course, into the industry as well as into what's in store for FY26. Couple of monitorables that viewers will obviously keep in mind as well that we spoke about. But out of time on this one. Thanks for coming and speaking with us.
Thank you.
All right. So, and viewers, completely out of time on this edition of KYC as well. Hope you found it helpful. Stay tuned to NDTV Profit. More action on the other side.